As a global oil crisis threatens to send prices soaring, Wall Street just poured a massive $1.5 billion into Bitcoin ETFs in only 5 days. According to Lark Davis, this isn't panic buying. He shows how the U.S. is stabilizing the situation, allowing institutions to strategically buy the dip in the $60,000 range. But the channel Crypto Tips paints a far more urgent picture. They point to $90 billion flooding the market as the Fear and Greed Index hit rock bottom, arguing large wallets are accumulating Bitcoin as a true safe haven asset against coming inflation. Meanwhile, CryptoWendy warns of a completely different battle. While markets react, Jamie Dimon is fighting to regulate stablecoin yields out of existence, a move that could fundamentally change the entire crypto landscape. So which powerful force will win out? The answer will define the next cycle.
In the latest video from Lark Davis channel, we get a look at how global markets are reacting to major geopolitical moves in the Middle East. The big story is the effort to keep the Strait of Hormuz open, with the U.S. stepping in to backstop insurance for all shipping and even offering to escort tankers with the Navy if needed. This has calmed the oil markets, which were on edge about a potential shutdown of a route that carries 20% of the world's oil. It seems the markets are pricing in the idea that the strait will remain open one way or another. On the crypto front, there's a lot of action. Wall Street appears to be buying the Bitcoin dip with a massive $1.5 billion flowing into Bitcoin ETFs over the last 5 days. This suggests that big money saw Bitcoin in the $60K range as a buying opportunity. The speaker also dives into the charts, noting that Bitcoin has broken above its 20-day EMA, a move that historically led to a significant price run. There's also a mention of a long-term bullish outlook based on a lunar cycle theory, pointing to a positive trend through late 2028. Beyond Bitcoin, he touches on ETH, which is building within a large triangle pattern, and other plays like MicroStrategy, which he's personally buying as a leveraged bet on Bitcoin's rise. The video presents a compelling, albeit hypothetical, scenario where decisive military and financial action in the Strait of Hormuz calms volatile energy markets. While the specific events described aren't currently happening, the underlying theme, that markets quickly price in geopolitical risk, is a timeless one. Recent tensions in the Middle East have indeed caused jitters, but markets often show resilience once a conflict scope becomes clearer. The more immediate and factual takeaway is the commentary on Bitcoin ETF flows. The video's mention of $1.5 billion in inflows aligns with real-world trends, where institutional interest remains a powerful market driver. Recent data confirms that after periods of outflows, capital is flowing back into these products, with net inflows of $225 million recorded on March 3rd alone. This dynamic, where institutional dip buying provides a floor during corrections, has become a defining feature of the current crypto cycle, lending credibility to the video's analysis of Wall Street's behavior. In the latest video from the Crypto Tips channel, it's explained how $90 billion flowed into the cryptocurrency market, largely because Bitcoin was seen as extremely oversold. The Fear and Greed Index hit a low of 5, even lower than during the FTX collapse, signaling extreme fear. A couple of major world events are presented as the main drivers for this shift. First, news broke that Iran might have made an offer to the U.S. to end the conflict, which gave the market a little bump. More importantly, the effective closure of the Strait of Hormuz is causing a massive logistical nightmare. With Saudi Arabia running low on oil storage and thousands of ships stranded, the stage is set for a dramatic spike in oil prices. Goldman Sachs predicts oil could jump 30% to $100 a barrel, which would make everything that relies on oil, from transportation to consumer goods, much more expensive. The speaker argues this looming inflation and global uncertainty are pushing people, especially smart money, toward Bitcoin as a safe place to store their wealth. It's interesting to see Bitcoin's price climb while traditional safe havens like gold and silver have actually dropped. The video also dismisses critiques from figures like Ray Dalio, suggesting he's out of touch with where modern finance is headed. The core message is supported by a chart showing that large Bitcoin wallets, those holding between 1,000 and 10,000 Bitcoin, have been steadily buying up more coins as prices dip. This suggests that the big players are preparing for what's next. What do you think this smart money knows? The video's central theme, that geopolitical crises can drive capital into Bitcoin, is playing out in real time. Recent events in early March 2026 confirmed the speaker's concerns, with a conflict involving the U.S., Israel, and Iran leading to a de facto closure of the Strait of Hormuz. This has caused a significant spike in oil prices, with Brent crude reaching over $82 per barrel. Goldman Sachs has even updated its forecast, suggesting prices could hit $100 if the disruption continues. This validates the video's prediction of rising oil prices and subsequent inflationary pressures. Interestingly, Bitcoin's reaction supports the digital gold narrative. After an initial dip, it showed surprising resilience, recovering its losses while traditional markets remained volatile. This behavior diverges from past crises where Bitcoin often sold off with other risk assets. The current market dynamic suggests a growing perception of Bitcoin as a temporary safe haven, particularly as a hedge against fiat debasement and geopolitical turmoil. This is happening alongside a broader trend of institutional adoption, with clearer regulatory frameworks emerging in the U.S. and globally throughout 2025 and into 2026, further legitimizing the asset class.
In the latest video from CryptoWendy, she breaks down JP Morgan CEO Jamie Dimon's recent comments about putting crypto on a level playing field with banks. Dimon is pushing for crypto exchanges that offer yield on stablecoins to be regulated exactly like banks, covering everything from FDIC insurance to liquidity and AML requirements. Wendy argues this is a move to protect the bank's bottom line, as they can't compete with the 4 to 6% yields from stablecoins while they offer less than 1% on savings. She points out that crypto is already way more transparent with proof of reserves, and that most exchanges are already compliant with KYC and AML rules. This whole debate, especially over stablecoin yields, is the very thing holding up the crypto market structure bill, which is now blown past its March 1st deadline. Dimon seems okay with rewards on transactions, but not on idle balances, which Wendy says is just another way to keep retail investors from growing their money. It's a classic case of old money trying to stifle new school financial innovation because it threatens their profits. The standoff between Jamie Dimon and the crypto industry perfectly captures the tension between legacy finance and emerging financial technology. Dimon's call for a level playing field is, on the surface, about consumer protection, but it's fundamentally a defensive strategy. Banks are threatened by the superior yields offered in DeFi, which could pull significant capital from their low-interest deposit accounts. This battle is currently playing out in Washington, where the Clarity Act, a key piece of market structure legislation, remains stalled specifically because of this disagreement over stablecoin yields. While Dimon frames it as a risk issue, major financial institutions, including his own JP Morgan, are actively exploring tokenization and blockchain for settlements, showing they recognize the technology's power. The reality is that stablecoins and tokenized assets are becoming foundational pillars of a new financial infrastructure, with institutional adoption growing steadily. The delay in regulation doesn't stop innovation, it just creates uncertainty and allows incumbents to try and shape the rules to protect their own interests.
After analyzing these three perspectives, a powerful pattern emerges. The clear consensus is that sophisticated capital is actively moving into Bitcoin. We see this in the massive ETF inflows, the accumulation by large wallets, and even in the defensive posture of legacy banks trying to regulate their competition. The primary disagreement, however, lies in the why. Is this a flight to safety driven by geopolitical fear and a potential oil crisis? Or is it simply Wall Street tactically buying the dip once those fears were calmed? The key takeaway is this: regardless of the specific catalyst, institutional players are treating Bitcoin as a serious macro asset. Their actions, more than any single headline, are defining this market cycle.